There is a number that banks do not want you to know about, not because it is illegal, not because it is a loophole, but because once you understand it, you start seeing the entire financial system differently. That number is $8,000, and the rule built around it has quietly shaped the way millions of Americans move, store, and protect their money without ever realizing it. Let me back up for a second. Most people assume that their money, once deposited into a bank, is essentially invisible to the government. You earned it, you taxed it, you put it in your account. Done. Private. Yours. But that assumption is wrong in a very specific and very important way. And the moment you trip over this rule without knowing it exists, your life can get complicated very fast. Here is what actually happens behind the scenes. Every single bank in the United States is legally required to report certain transactions to the federal government, not just suspicious ones, not just criminal ones. Any cash transaction above $10,000 triggers an automatic report called a currency transaction report, or CTR. The bank fills it out, sends it to a federal agency called FinCEN, the Financial Crimes Enforcement Network, and that report sits in a database with your name on it. You do not get notified. You do not sign anything. It just happens. Now, most people hear that and think, fine, I never moved $10,000 in cash anyway, so this does not affect me. And that is exactly where the story gets interesting, because someone at some point figured out that the reporting threshold was $10,000, and they started breaking their deposits into smaller amounts. $9,000 here, $8,000 there, sometimes even smaller. The idea was simple. Stay under the radar. Avoid the report. Keep things quiet. What happened next is one of the more quietly terrifying things in American financial law. The government noticed the pattern, and instead of just raising the reporting threshold, they created an entirely separate crime. They called it structuring. And structuring is the act of deliberately breaking up financial transactions to avoid triggering federal reporting requirements. It does not matter if the money is completely legal. It does not matter if you earned every single dollar legitimately. If you intentionally keep your deposits under $10,000 to avoid the report, you have committed a federal crime. The penalty can be up to 5 years in prison, and the government can seize every dollar involved. This is where the $8,000 figure becomes so significant. Because while the law technically applies to any deliberate avoidance of the $10,000 threshold, the number that started showing up most frequently in prosecuted cases, in banking alerts, in suspicious activity reports filed by tellers, was right around $8,000. That number became, in practical terms, the de facto danger zone. The sweet spot that looked, to investigators, like someone who knew exactly what they were doing. And here is the thing that nobody talks about. The people who got caught were not always criminals. That is the part that should make you sit up straight. There was a case, a real one, involving a small business owner in Iowa. He sold farm equipment. He had been depositing cash from sales his entire working life. His deposits were usually between $7,000 and $9,000 because that is what his customers paid him. He had no idea about structuring. He had never heard the word. He just deposited what he had. And one day, federal agents showed up, froze his accounts, and seized over $30,000. It took him years and enormous legal fees to get it back. He was never charged with a crime, but the money was still gone for a long time. That case is not unique. Between 2013 and 2015, the IRS seized over $17,000 on average from small business owners who were never charged with any crime, just depositing cash, running normal businesses, gas stations, restaurants, convenience stores, nail salons. These are not cartel operations. These are your neighbors. So why does this keep happening? Because the law, as written, does not require the government to prove that your money was dirty. It only requires them to show that you structured your transactions with the intent to avoid reporting. And intent, as prosecutors and defense attorneys will both tell you, is an incredibly elastic concept in a courtroom. Now let us shift gears slightly, because there is another dimension to the $8,000 rule that most people overlook entirely. And it lives not in criminal law, but in everyday banking behavior. Banks are not passive participants in the system. They are active partners. Every bank teller, every branch manager, every compliance officer is trained to watch for patterns, and the training specifically flags transactions that seem designed to hover just under 10,000. A customer who comes in every week with 8,000 in cash. A business that regularly deposits exactly 7,900. These patterns generate what are called suspicious activity reports, or SARs. And unlike CTRs, which are automatic, SARs are discretionary. The teller thinks something looks off, the bank files a report, and now your name is in a different database, one that can trigger an investigation at any time. The number of SRs filed in the United States every year is staggering. In 2022, banks and other financial institutions filed over 3.5 million suspicious activity reports. 3.5 million. And the vast majority of the people named in those reports had no idea they had been reported. They thought they were just banking, depositing money, doing normal things. This is the invisible machinery of the modern financial system. And it runs constantly, silently, and with almost no transparency to the average person. Here is what makes this even more infuriating. The original intent of these laws was genuinely good. The Bank Secrecy Act of 1970 was designed to cut off money laundering, drug cartels, organized crime, arms trafficking, real serious criminal enterprises that were using cash to hide dirty money in the banking system. Nobody is arguing that those problems do not exist or do not deserve serious attention. But the tool built to fight those problems has, over time, been turned on ordinary people, small business owners, independent contractors, people who work in cash-heavy industries, farmers, tradespeople, anyone who lives and operates in a world where large cash transactions are completely normal. The gap between who this law was designed for and who it actually catches is enormous, and banks, to be direct about it, have very little incentive to narrow that gap. Every report they file protects them from legal liability. If they miss a real criminal and did not file a SAR, they face massive fines. If they file a SAR on your completely innocent nail salon, nothing bad happens to them at all. The incentive structure pushes toward over-reporting, which means more innocent people end up in the system. Now let us talk about what you can actually do with this information. Because the point is not to scare you. The point is to give you knowledge that most people simply do not have. First, if you run a cash business, document everything. Every transaction, every sale. Keep records that clearly connect your deposits to legitimate income. This sounds tedious. It is also the single most powerful thing you can do to protect yourself, because the defense against a structuring accusation is almost always the same, showing that the amounts were not chosen to avoid reporting. They were simply the natural result of normal business operations. Second, talk to your bank. This sounds almost absurdly simple, but it works. If you regularly deposit amounts that might look unusual, have a conversation with your branch manager. Explain your business. Explain why your deposits are the size they are. In many cases, this alone is enough to prevent a suspicious activity report from being filed because the teller's concern is intent. If there is an obvious, documented, legitimate reason for the pattern, the concern evaporates. Third, understand the difference between a currency transaction report and a suspicious activity report. CTRs are automatic above 10,000. You cannot avoid them, and you should not try. If you have a legitimate reason to deposit more than 10,000 in cash, just deposit it and let the report happen. The report itself is not a problem. It is just paperwork. The problem only starts if someone starts looking at that report and finds something that does not add up. If everything adds up, you have nothing to worry about. Fourth, and this one is genuinely underused, if you are ever contacted by federal agents about your banking activity, say nothing until you have spoken to an attorney. This is not paranoia. This is the same advice every single defense attorney in America gives every single client. Even if you have done nothing wrong, even if you are 100% innocent, the investigation, the questions, the interpretation of your answers, these are all things where having legal counsel makes an enormous difference. Now here is the turn in the story that a lot of financial commentators skip past, and it is worth stopping on. The $8,000 rule, the structuring law, the entire apparatus of bank secrecy reporting, it exists within a system that also quietly and legally allows enormous amounts of wealth to move in ways that attract almost no scrutiny at all. If you are wealthy enough, you move money through trusts, through shell companies, through investment vehicles, through wire transfers between entities that look nothing like a person standing at a teller window with a stack of cash. Those mechanisms are legal, available, and largely invisible to the kind of surveillance we have been discussing. The cash depositor, the small business owner, the person who works in an industry where people pay in paper money, these are the people who live under this level of scrutiny. Not because they are more likely to be criminals, but because their financial behavior is more legible to the reporting system. They show up clearly on the radar, and the radar was built to flag what it can see. This is not a conspiracy theory. It is a structural reality that financial regulators, legal scholars, and civil liberties organizations have been writing about for years. The Institute for Justice, a nonprofit legal organization, has litigated multiple cases on behalf of small business owners who had their money seized under these exact laws without ever being charged. Their argument, which has gained significant traction, is that civil asset forfeiture combined with structuring law creates a mechanism for government seizure that bypasses the normal protections of criminal due process. Think about what that means in plain language. The government can take your money, not charge you with a crime, make you fight to get it back. And in many cases, the cost of fighting is higher than the amount seized, which means many people simply give up and lose money that was entirely theirs. In 2015, the IRS announced it would change its policy and focus structuring investigations only on cases where the underlying funds were connected to illegal activity. That was a significant shift. But the law itself did not change. The policy can change back. And in the meantime, civil forfeiture through state law, which varies dramatically by state, continues to operate in ways that affect real people every day. So where does this leave you? What is the actual takeaway from all of this? The $8,000 number is not magic. It is not a safe harbor. There is no deposit amount that is automatically safe or automatically suspicious. What matters is pattern, intent, and documentation. If your deposits reflect real economic activity, and you can show that clearly, you are in a fundamentally different position than someone who is deliberately engineering transactions to fly under the radar. But the broader lesson is this. The financial system you interact with every single day is not a neutral utility. It is a reporting infrastructure. Every transaction above a certain threshold gets documented. Patterns get flagged. Databases get populated. None of this happens with your explicit knowledge or consent. It just runs all the time in the background. Most people will go their entire lives without ever getting a knock on the door because of any of this. But the ones who do get that knock are often the ones who were most confident that they had nothing to worry about, because they did not know the rules. And not knowing the rules has never once been a legal defense. The farmer in Iowa did not know. The restaurant owner in Tennessee did not know. The hair salon owner in Michigan did not know. These are not hypotheticals. They are documented cases. Real people who lost real money and spent real years of their lives fighting a system they did not know was watching them. Here's the final thought, and it is the one worth carrying with you. The title of this video mentions that banks hate this rule. That is a bit of a provocation, because in reality, banks are deeply enmeshed in this system. They built their compliance departments around it. They train their staff around it. They file the reports. They are, in a very real sense, the enforcement arm. What banks actually hate is the liability, the cost, the legal exposure, the massive fines for getting it wrong in either direction. A bank that misses too many suspicious transactions gets hammered by regulators. A bank that over-reports innocent customers does not face the same consequences. So, the incentives point in one direction, and ordinary account holders are the ones who feel it. Understanding this does not mean the system is evil. It means the system is a system. It has logic. It has incentives. It has blind spots. And the people who navigate it most successfully are the ones who understand how it actually works, not how they assume it works. $8,000, a number that sits below a threshold, a number that became, over decades of enforcement and pattern recognition, a kind of invisible tripwire. Know it is there, know why it is there, and know that the best protection you have is not staying under it or staying over it. It is understanding exactly what the people watching are looking for and making sure that everything they see tells the true story of where your money actually comes from.